Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network.
Before we get into today's show, there are a few things we have to go over.
Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you'd get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program.
G'day, Nick. Welcome to the Australian Investors Podcast. How are you going?
Very well, thanks. Thanks for having me on. Really appreciate it.
Yeah, really excited to have you on. First things first, I understand the name of your fund, Fairlight Asset Management. There's a bit of an interesting story and history and also meaning behind it.
Yeah, a little bit of history there. The fund sort of came into fruition after some deliberation after leaving Evans and Partners, where I'd been for a few years and had a good time there, and left on good terms with the partners, but was seeing out my non-compete period, and we were living down on Fairlight Beach at the time, which is a tiny little beach on Sydney Harbour. Most people aren't familiar with it, and I was speaking to my lovely wife at the time, and we were trying to figure out what to do with our lives. And she's got a background in marketing and brand for funds management businesses, and I've got an investing background, and happened to also grow up in Fairlight a long time ago and moved back to the area in the last 12 months and sitting on that little beach. And we were saying, well, why don't we have a crack at starting a small and mid-cap fund, and what are we going to call it? And she said, well, Fairlight's got a really nice ring to it in terms of, the word itself, fair, which, that's not a bad thing, treating your clients fairly, and light, transparency. They're two sort of nice connotations to a word, and most people don't know that it's a little beach in Sydney, so most people just kind of associate the name with just a funds management business, but there is a little bit of meaning behind it. So I threw that name into the ring with the other guys who we were forming business with, and thankfully they agreed that it had a nice tone, and we ran with Fairlight Asset Management.
Yeah, I do really like the name, because I think when you say fair, I think it reminds me of independence. Yep. I think that's something that you've mentioned before in your previous podcasts and interviews, having an independent mindset about investing. So light kind of evokes that sense of measured optimism.
I'm glad you say that, because it's certainly got a lot of connotations to it, and we've had really good feedback on the name actually over the years, and usually from people who aren't on the northern beaches, you can kind of know it's a little area there, but most people, our clients in Melbourne and other parts of the country are sort of like that. They often say to us that's a nice sort of ring to it, and it's got some nice connotations. So thanks for the feedback.
Yeah. Just to go back to when you grew up in Fairlight, how did someone who was enjoying the beaches, enjoying the great weather, the great area, come around to investing?
Yeah, that's a good question. I don't have one of those stories about sort of having Warren Buffett or Munger up on my wall at the age of 12 or 13, or sort of having this deep desire to be the world's best investor from day one, or having complex algorithms etched into my mind from an early age. But I was just very fortunate that I grew up in a business household. So my father had an interest early on, or instilled an interest early on in investing. So he held stocks and subscribed to the newsletters of the time, some of them high quality and others more questionable, like the Rivkin report, which turned out to be a pretty interesting read over the years. But he was sort of an investor early on in hotels and pubs and shares, and it was always a point of discussion around the household, the importance of compound interest, how that works over time, and you want to be the owner of assets rather than sort of being the payer to those assets over time, etc. So that instilled interest in me over the years, and then I sort of went through school and university, studied business at university, and very, very fortunate that spent some time in a corporate, so UTC, which owned Chubb Security and FFE Fire and a bunch of other businesses. So they got to know the business world from the inside out. But learned pretty quickly that didn't really interest me. And I was fortunate enough that a friend of mine was working at Ord Minnett at the time, and they were looking for a very, very, very junior research associate. So someone that could literally plug some numbers into spreadsheets and sort of answer the questions of the advisors at the time. And that they asked me to come in and interview, and I was incredibly fortunate that I got the nod, and that really set me off in investing. I loved it from day one. So the first moment I was given access to what these guys did on a daily basis, I was completely enthralled by it all. Thought it was the world's greatest job, and knew that I'd be doing it for a long time. So I guess it was just a very lucky set of circumstances, and one which I think it's becoming more difficult over time to sort of have those serendipitous entries into the industry. I know that people work incredibly hard these days, and they have to get what seems like incredibly high hurdles for PhDs and CFAs and MBAs, and to get people's attention to get break into the industry is very, very difficult. But sort of going back to 30 years ago now, or 25 years ago, it was far easier and a little less onerous in terms of who they were happy to take a punt on. And I guess I was fortunate enough to get a foot in the industry.
So that was a generalist role, is that right, at Ord Minnett?
It was a very much a generalist role, and I was lucky at the time because Ord Minnett was part of JP Morgan, so they had the instos desk and then they had the retail desk, and I got to know sort of both sides of the business. But I was fortunate insofar as they gave me way too much responsibility early on as a young analyst, and so I was moved from a research associate into an analyst role, covering small caps in a generalist capacity, so some industrial businesses and some mining contracting businesses and basically all the companies the analysts didn't want to cover. So if you're a young guy cutting your teeth, they give you all the companies that usually clients don't listen to you much about, so you're very unlikely to blow up anyone's book or sort of make a fool of the firm. But it also gives you this wonderful opportunity to start building models from scratch, learning from the guys around you, and eventually at the periphery start pitching institutions, which I did. So starting to go around and talk to some of the big institutions and pitch these sort of fringe ideas of, there might be a little bit of alpha here. I know you probably haven't considered these businesses, but, have a bit of a look. And that very constant feedback loop that you get from pitching seasoned investors is invaluable. So you learn very, very quickly whether your thought processes have any merit or not, because you'll sort of be on the firing end of 5 or 6 pretty insightful questions pretty quickly, and you need to have answers to those. And it's an iterative process. The first one you come out of, the second one you come out of, you're pretty embarrassed, and then you go back and learn the answers to the questions that you should have known the first time around. And by the time you've done it 10 or 15 times, there aren't too many questions you don't have the answers to. And once you sort of build up that almost muscle memory of questioning and what's important in an investment, that becomes incredibly useful. The depth that you sort of that you generate through that process is kept me in pretty good stead, and you compound on that over the years, essentially.
Yeah, just on that point, when you talk about you were covering a lot of those companies where a lot of the others weren't willing to cover, did it provide you insights into what probably didn't look like a great investment?
It did, and a lot of the businesses I was covering were the good old Australian roll-up story, where you've got a pretty crappy industry, and you start with a balance sheet and you're buying tuck-in acquisitions on 3 or 4 times earnings, and it looks fantastic for a while. And the EPS accretion, or the earnings per share accretion every year, looks great because you've got a publicly listed company. This was back when you were buying businesses on 8 to 10 times EBIT rather than 15 times EBIT. Business are trading on these days, but 8 to 10 times EBIT, you're buying them on 3 or 4 times EBIT. So the EPS accretion that you get from that is incredible, and it's a bit of a drug. There's EPS upgrades every year, and things look fantastic. And the missing piece of the equation there is what's actually happening to the returns that you're generating from those businesses over time. And so the return on invested capital, the cash generation that those acquisitions have been making, start to decay. And unless you're looking at the right levers within the cash flow statement or the P&L or the balance sheet, that can be missed, and the drug of the EPS accretion can be sort of very seductive, and hanging on to those businesses for too long is a very, very bad idea. So there's definitely some lessons from those early days that have kept me in pretty good stead over the years on the buy side.
Just cycling through so many companies and just absorbing so much I guess, knowledge and you turn it into muscle memory. Did you have any methods where you try to compress everything and synthesize everything and into like key points just to really retain that knowledge, or was it just a matter of just doing everything?
Yeah, I mean, the early days was very much drinking from a fire hydrant. So, you know, as a young analyst on the sell side, you're not trying to cover 300 or 400 stocks. You're trying to know maybe 10 or 15 really, really well. And so you've got concise models, usually which you've built from scratch, and you've worked up an initiation note, and you've sort of gone through a lot of detail, and you expect to know those businesses quite well. Where the discipline or the infrastructure came in on compressing as much information as possible, or figuring out what's truly important about a business, really came from the next step of the journey, which was the lucky or fortuitous opportunity to pitch Schroders as a sell-side analyst, where I got to know a chap called David Wannis, who was working at Schroders and just launched the small and micro-cap funds for them. And through that process, I was really lucky that he was like, "Well, look, you're young, you're very enthusiastic. You probably don't know a lot, but I can sort of mold that into something that's a little more useful. So why don't you come and sort of work for us on the microcap fund, and you can sort of cut your teeth there in the funds management industry." And it was really through that process that I sort of learned the power of two things. Firstly, being incredibly organized with data, whether it's quant data or qualitative data. And secondly, there's probably three to five things max that are important about this investment. You need to know those 3 to 5 things. Everything else is nice to know, but you know, if you get the 3 to 5 things right, it's the old Pareto rule, especially as we're trying to cover sort of 500 stocks. You get to the nub of what's important very, very quickly. And so it was really that second stage of my career working with David that all that came together.
I think, yeah, when I first started investing, I think it's easy to get excited about gathering as much information as possible. But do you think you needed to go through that process to try and figure out what really mattered? Because when you say, I guess 3 to 5 key points, and are you trying to find data points that support those 3 to 5 qualitative key points that support your thesis?
Well, sort of how it's worked out over the years is we've actually got 15 checkpoints at Fairlight that we run through sort of from top to bottom. We debate those in the same way every single time, but as you run through those 15 checkpoints, there's usually 3 of those checkpoints that are going to drive the majority of the investment thesis. So it was I don't know if you want to step through all the way through to Fairlight at this point, but it was very similar when I was at Schroders. You know, we had a very formulaic way in which we discussed stocks, and you go through in quite some detail and sort of building out those theses, etc. But what we learned, especially with David, was a little bit different from the large cap team, because they were to discrete, smaller opportunity set where you sort of need to know things in a lot more depth. But working with David, it was really a sense of yes, we're going to have some detail on these businesses, but what is it that's going to be driving the investment thesis here? Is it going to be the organic growth rates? Is it going to be the margin? Is it going to be the buyback they got in place? Is it an interesting acquisition that they've made? Is it a new management team? What is the crux of this investment thesis that's going to drive the returns over the next 3 to 5 years? So it's, to your point, it's like you need to know the detail, but within that detail, what are the important things that are going to be driving the business? What I'm not a big believer in, and continue to not be a big believer in, is financial models that have got 30 to 50 lines building up to a revenue input, because just the mathematics of probably, you know, even if you get sort of an 80% probability on each of those lines, by the time you get to the revenue line, the probability of getting them all right is very, very low, just the way that the mathematics work out on probabilities over time. It's very, very difficult to get to a precise answer. So we keep things as simple as possible, but no simpler than they can be. So what are the sort of true drivers here? Let's not kid ourselves, we're going to be completely accurate, but going through the discipline of building out a model sort of tells you what is important about the business. But what you don't need to do is get into the minutiae on things that really don't matter. So avoiding that is very important, and it gives you a lot more breadth and sort of opportunities to compare and contrast across more businesses.
Yeah. I'll be really interested to find more about how David played that mentoring role, because I think most experienced fund managers can really pull apart, what's, as you said earlier, what's really important. Was it a matter of him reviewing your model, reviewing your work, and then really putting the question towards you, and then trying to think in the same way he does?
What I was really lucky with David was that all the infrastructure is already in place. So I don't have to make any claims of being a genius from an early age. I was just really lucky that I sort of stepped into a business where, someone had taught him, and the guy before him had sort of given him some tips, and that sort of concertinaed down to this opportunity where I walked in, and essentially there was a model template that was already built, and there was a stock discussion note with already had some points in it. So it was really about, how do I understand how these elements come together? So for any young analyst, it's all about sort of hitting F2 a million times before you ask too many questions of your superior, to make sure you sort of understand things before you sort of tapping their time too much. But we had those two tools, and then what essentially he did, which I was really fortunate about, was that he'd already done the first screening process. So of the, I don't know how many thousands of businesses there are in the small and microcap index these days in Australia, but he essentially had a stack of about 100 annual reports, which he just dumped on my desk, and he said, these are the businesses I think look interesting. We need to get this down to a portfolio of 30 to 40. That's what I'd like your help with. And so from day one, I was reading about interesting companies that I knew that he'd already done the filtering process on. So that sort of element of not wasting time and starting to, once again, to get that muscle memory of what a good business looks like, while it involved a huge amount of work, I was very fortunate that the heavy lifting in that instance had already been done by David, and I sort of had the pleasure of his work that had been done over time, the pleasure of or the benefit of that work that he'd done over time that had already been filtered down into that level. So I guess I was just very lucky on that front.
So moving forward, I think, so you've developed the whole toolkit. I think David's passed on the skills that you needed to become a pro or elite analyst, and then you move forward to becoming a co-portfolio manager at Evans and Partners. Is that right?
Yeah, there was one step before that. So I was working with David in the small and micro cap products, and I was working as an analyst on the large cap product at Schroders as well on the retail side. And through that process, I was really lucky to be invited to move to New York and work with a lady called Jenny Jones, who has one of the most formidable small cap track records in the US. She's very well known over there and incredibly well known within the Schroders business. And so moved over there, and for a few years worked under her tutelage, which once again, sort of what I learned from David was the power of putting together funds management with very strong IT systems, and sort of making sure that you're collating data in an incredibly efficient way and getting to a very structured outcome. From Jenny, it was a little bit different insofar as she was very much style driven. So she had 3 styles of investing run through her portfolio. She had sort of growth, sort of compounding sort of bucket, a little bit more of a value bucket, which I learned and have instilled in the Fairlight process as well. So we've got something very similar to that. We call them slightly different things. And she had a couple of extra sort of esoteric buckets that sort of we've dropped over time. But the idea of having 3 opportunity sets was very, very instructive to me. The tweak that we've made is that we've got a very strict adherence to anchoring everything into quality. So less so with Jenny. She was very happy to look at unprofitable businesses and companies that were generating just below their cost of capital and hoping they improved over time. Whereas Fairlight, we want businesses that are generating a good return on their invested capital above their cost of capital from day one. But having these 3 styles, I could see how that they move differently in different market environments. And people sort of say, well, why would you do that? You should choose one style that does the best over time. Well, what you're sort of missing there is the opportunity cost of being able to recycle capital. So during difficult market periods, it's nice to have some stable businesses in there that you can use as a bank, if you like, to really sort of move that capital into your higher growth names when they've been sold down by 30 or 40%. And then low risk turnarounds act a little bit more like value. So when you get a value rally, they can sort of help you keep up a little bit in those periods. So that was very, very instructive. And Jenny works very, very hard in New York culture, and got to know sort of how the business world worked over there, and to see if there was any advantages or disadvantages of working on Wall Street, or the equivalent of, I was actually in Midtown, most firms are these days, but whether there was any advantages of being based in New York or London as compared to Sydney, or, quite frankly, Auckland. Whether you need to be in those big sort of big business centres to drive a return or not. So that experience was great as well, and then eventually moved to Evans Partners.
Yeah. Do you think it made a huge difference being in that bubble in New York?
What I found was it was a really interesting experience, but what ends up happening is that you get distracted really quickly. So to give you an idea, I come into the office, and a little bit different to Sydney-based offices insofar as we had our own office, and so you walk in, you sit down at your desk, and you got your computers. It was quite isolated in some ways. You're not less of a sort of team feel to it, but your voicemail will be filled up with 30 to 40 calls from brokers before you even get in there, and it's like, here's our new research, or we're bringing someone through town, or whatever it might be. So you end up, and because we were also running a less concentrated fund, we had a sort of over 100 names. You end up sort of investing and meeting with businesses you wouldn't ordinarily think to do if you were sort of running a more concentrated fund. So you're meeting with these sort of fringe businesses where they're not as high quality, but they're a bit of a portfolio filler, and you need to have 30 or 40 names in your own coverage to sort of fill out a portfolio, and so that piece I don't think is very accretive. Sort of meeting with brokers, trying to figure out who on the brokerage side are good analysts, and sort of trying to drill into their model. You spend as much time sort of figuring out who's good on the sell side as you do speaking to management teams. So that's really distracting. The second was the volume of companies coming through the office. So you'd spend a lot of your time sort of meeting with businesses that you probably never invest in, but you need to, because you're on the sort of rotation of these companies coming through on an annual basis. I don't think that was particularly accretive. The second thing was that it was pretty clear to me that the only advantage you have from sitting in Wall Street or London is a long haul flight. So if you're going to be sitting in Sydney, you really nullify that if you're happy to sit on a flight for 15 hours and land in LA or wherever it might be. And then you still got to get on a flight to go to the Midwest or down to Texas or wherever, and then if you're investing in UK businesses, you got to fly across the UK anyway. So the advantages there, I think, are pretty spurious, to be frank. And then the idea of buying a whole bunch of sell side research, we really don't do that. We speak directly to management teams, build our own models, do our own work on those businesses. So I really genuinely don't think there's an advantage of being that part of the world. And I know it's a bit of a cliche, but after all, Warren Buffett's based in the middle of the country. It doesn't seem to affect his returns at all.
Because I imagine it would have taken so much time. The whole process would have been quite time intensive, going through so many companies, and then so many brokerage calls and sell side reports of businesses that you probably won't even end up investing, right?
That's right. It's just a huge time sink. And so instead of doing that, why don't you just say, well, there's 200 companies globally, or maybe 300 companies globally that are ever going to be of interest to us because they fit all of our criteria, and then focus on those. So instead of sort of sitting in New York or London and waiting for companies to come to us, we've got a short list of businesses that we want to get to know well, and we'll jump on a plane, go and meet with their management team, form a relationship. Over time, it becomes a trusted relationship, so we can kind of help with things along the way if they ask for it. And that way, we're fishing from the right pond. We don't have to be distracted by the third or fourth tier business, which it's never going to cut mustard for us. And even sectors that, we're not interested in either. So we cut out a huge amount of the market by only investing in 4 sectors, which I'm sure we can get onto later on when we talk through process, etc. But that whole idea of covering the entire market and having a huge team, and the distractions that come from the communications, not only with your team, but the brokers and the businesses that you're never going to invest in, it just creates a web of misguided effort that I just don't think is particularly useful.
How about the lifestyle and cultural aspects of meeting management? Do you think it really helped you a lot in terms of better understanding companies to invest in your current fund?
I think so. I mean, with the Australian small and micro cap market, it's absolutely valuable. So because they're such small businesses that essentially if they're making a few hires, it's going to move the P&L around a bit. So and the personalities there are going to drive the returns to a degree. For Fairlight these days, yes, management is really, really important, and we meet with them and we get to know their culture, etc. But there's a lot more you can do as an individual investor, which a lot of your listeners are, that you don't need to be quite as, I guess, paranoid about what management are doing from a day-to-day basis. And the reason for that is usually in the areas that we're investing small to mid caps. So the weighted average market cap across our portfolio looks very much like the ASX 200, to give you an idea. These are established businesses. Many of our companies have been around for quite a few cycles. 85% of them are around before 2008, 2009, to give you a bit of a view there. A lot of the cultural aspects, etc., come through in the annual reports. So you're reading the annual reports and the letters from these guys, and you can kind of check box, what did they say last year? Did they execute across that? Yes, no. And they can also withstand a bit of a period of mismanagement. So you don't want bad managers running your businesses forever, but if a new team comes in and they're doing a subpar job, usually, especially in the States, they get moved along reasonably quickly if they're not, if they're not doing a good enough job. And so sometimes sort of being completely impatient there and sort of selling the business down to zero, often that's not the best idea. So yes, we meet with management teams, we voice our concerns, etc. There's usually activists that are sitting in the background ready to sort of step in if it's 18 months of misguided management. But you don't need to be talking to these guys every day to get a really good view of the culture and the direction of the business, I guess, is the message I'm trying to provide.
Just one more question about your time with Jenny. You said that she was much more focused on maybe proof of concept companies that weren't profitable. Was there any reason why she was more allured to that basket?
It's actually a little bit different. It was less proof of concept businesses. So she wasn't ever really sucked into the new narrative on the latest IT or tech stock or concept stock. It was more, is there a business here? And it's kind of a little bit more like the guys at Platinum do a good job here. It's more like the cyclical companies that are out of favor, that are making a loss. We're happy to sort of see cyclical return to businesses that can generate a decent return on their capital the years 2, 3, and 4 years out. That's not what we do at Fairlight, which Jenny was quite good at, but we don't give ourselves a passing grade there, so we simply don't get involved.
Was the main reason why you guys didn't pursue that was because of the repeatability of that process?
There's a repeatability of the process, and also just a recognition that very few people can time markets and time cycles within markets. So what we're trying to do is find businesses where the amplitude of their cycle is quite low. So yes, all businesses are cyclical, we recognize that, but there's a difference between a company. One of our litmus tests, and the guys that are in the team sometimes give me a fair bit of grief about this, but I remind them I'm just going back to see what worst case scenarios can be here. But one of the things that we insist on when we go through our process is building a model from scratch that captures 07 through 10. And it's really not about saying, look, are we expecting another GFC? Probably not. But how did that business go through that period? And how cyclical was it? If earnings were negative or they were down 90%, then the next cycle might not be as bad. But there's some information value there that tells us that the company is not as robust as maybe we hoped it would be. Now, there might have been some changes over that time that's made it a little less cyclical over time, but that's a reasonable litmus test. So to give you a bit of an idea, like the average sort of downturn in earnings across our portfolio was around 20% during 2008, 2009, which none of them made a loss. So we've got a fair bit of confidence there that if we go through a downturn, we can either buy with confidence, or we know that we're not going to get completely blown up from a business perspective, where we don't know what the returns of the fund is going to be, but at least we know our companies are going to be around during that time. So it's just taking that element of cyclicality out of the decision making, which just helps everyone sleep a little bit better at night and buy with confidence during downturns.
Now we can finally move forward to your opportunity with Stephen Arnold, where you where you were a co-manager at Evans and Partners. Having listened to Stephen Arnold speak with us previously, he did value the importance of someone who traveled around the world and had that worldly experience, something that you had. So that was probably one of the key reasons why he chose you to partner with.
I like to think there's a lot of reasons we ended up partnering together. And we got along personally from day one, which is nice. And we had a lot of overlap in the way that we thought about investing, and we had similar outlooks on the world, etc. And I just wanted to make it really clear that I joined Stephen, and Stephen had already built that product out. So full kudos to him for the success that he sort of developed within Evans and Partners before I arrived. Just want to make that crystal clear.
Yep.
But learn a lot under Stephen's tutelage as well. So I've just been really fortunate to have three fantastic mentors in David, Jenny, and Stephen. And really what Stephen instilled in me was this sense of, don't make compromises on quality. You don't need to buy the second and third tier business, even if they look a bit cheaper. Often there's reasons for that. And so, you really want to be buying the number one, and maybe at a stretch, the number two in the industry, but really the number one in the industry. It might even look a little tiny bit more expensive, but the majority of your returns you're going to get over time is going to be from EPS growth, not from a re-rating in the stock, over reasonable timeframes, hence why we invest over 5 to 7 years. And so, I was already thinking down that line, but I think that why Stephen was happy to partner with me was that he essentially saw that, I was already there and very happy to sort of take that up a notch on the quality of the businesses that we invested in. And it was a very happy marriage for the time that I was at Evans and Partners, that's for sure.
How about on the quantitative side of things? Did you learn a lot from Stephen as well?
Yeah, I mean, he's got a very interesting approach to the way he looks at businesses. So he's got this sort of idea of capital drag and what that sort of means for the way that he values stocks. We do things a tiny bit differently at Fairlight, but we're sort of arriving at the same area. We're looking for businesses that are capital light, good returns on capital. You don't need to investing in capex and working capital to grow the business every year. So we end up at a pretty similar spot. I'm not too sure if they've formalised it, but we use the Croaky score, cash return on cash invested, which adds back the amortization, depreciation, every write down that a management team's made to get a true cash return on every dollar of capital that's ever been invested in a business. So they've got similar disciplines, I think, across the AORIS mindset. So it might be slightly different metrics. They might use returns on gross capital or whatever it might be, but we're both pointing at the same thing. And so, yeah, there's definitely some learnings there. And also the discipline that he instilled in the way that he executes that process was over and above. So if we had at one end, learning from David was the 80-20 Pareto, let's get this down to a workable list, which I think he does better than anyone in the market. And then the discipline that Steve's got around the mindset of only owning 10 to 15 businesses. I mean, you're going to be pretty sharp around the discipline you need to execute that with confidence. The combination of those two things have been invaluable.
What was the decision-making process like between yourself and Stephen?
Yeah, I mean, we were portfolio managers, but during that journey, I made it very clear to Stephen, it was very much the case that he was the guy that was, he built the strategy. I was there as his 2IC. That was the role that I performed within that business. He's sort of been investing in international markets a lot longer than I had, and I was very mindful that he was the guy that was going to be teaching me rather than the other way around. Albeit I like to think that maybe learn a couple of things from me over the years, but it was very much a sense of a structure in the way that we sort of discuss stocks, and very similar to what's carried through to Fairlight. So having an idea of sort of a checklist manifesto on the businesses, on the elements of the businesses you're discussing, and usually the answer falls out of the bottom of that, and so it becomes pretty clear whether this is a good investment or not. So that process was really disciplined at Evans and Partners, and it's something that I think it's also flowed through to Bob Desmond's business at Claremont. Being very disciplined in the way that you discuss and debate the inputs to an investment is sort of more important than the outcome in a lot of ways, because I think people are very quick to come to a buy-sell decision, but they haven't really investigated the ways that they've got there. I think that Stephen did a pretty good job on making sure that you're actually checkboxing everything on the way through.
So just reflecting upon your experience, your work experience, firstly, you worked at Ord Minnett, where you covered probably the most number of stocks as possible, and it's slowly decreased over time, like that pool has shrunken.
Yep.
So do you feel like you have more time on your hands now compared to when you first started in the industry, or less time?
As a father of two, I clearly say that I've got way less time than I ever have in my life. But I think what's really liberating is just that you've got a much clearer sense of the kind of businesses you're prepared to do the work on. So we are very, very quick to cut things. So we might start with our filtering process, which generates maybe 15% new names per quarter. We look through that list and we are incredibly quick to cut them. And then we've worked through a process of sort of where we're a little bit different from the market, I think, is on our stage 2 of our process, where the learnings from bigger institutions have really come through for us. So on things that you don't want to repeat, and that it's no fault of a big institution. It's kind of where you become sort of bureaucratic over time unintentionally. So what we do on stage 2 is, rather than doing a huge body of work and sitting around a table and doing a 1 hour deep dive into a business where you've visited all the management teams and everyone in the supply chain, you expected to know every answer to a question. We don't do that. We automate the first process, and it's really about having someone who's a quarterback to bring all that information to bear. And then we've got 4 minds around the table, scrubbing that idea down and saying, is this worth doing more work on? And if it is, we know that we're 80% of the way there. And that's where we turn into market animals. We're getting on planes and sending Will off to live in New York for 6 months of the year last year and visit these companies and speak to the supply chain and speak to the private equity players and management teams and different tiers of management, modeling the business back through 2006 for all the annual report data and adding back the cash, or adding back all the elements to the balance sheet that are important to get to a true cash number. That's a huge body of work. And so we want to make sure you're doing that on your most efficacious ideas, because you're going to have a huge time waste if you don't get to something that's investable, and secondly, it's about morale. So if someone spends that amount of time working on a business and you get to the last step and you're like, well, there's a off balance sheet liability here that's twice the size of the market cap, we're never going to buy it, we should have picked that up on stage 1. So it's really about the liberation that comes from only working on the world's best businesses in the small and mid cap market. It just means that your probabilities of that being a decent investment increases, and so your efficiency increases, and also the morale of the team increases by quite a factor.
For that stage 1 process where you're doing the biggest filtering process, but what are the key things that you look out for?
Yeah, so we've got stage 1, which is our filtering process, stage 2, which is that rapid analysis piece, stage 3, which is the sort of deep dive into the business, and stage 4, which is the decision on the actual portfolio. Stage 1, which is the screening process, we're trying to reduce risk as much as possible. So we're not invested in emerging markets, so developed markets only. So that knocks out quite a few businesses. We're only invested in 4 sectors, and those sectors which have the greatest density of businesses with great returns on capital. So it's healthcare, technology. We're sort of invested in what we call niche tech there. So not many of the high flying tech names that you hear about. So healthcare, technology, light industrials, so companies that aren't deeply cyclical. And then sort of every once in a while we find a media and consumer business which passes muster, but usually it's business to business, high customer retention rates, 98% customer retention rates, where we're sort of looking for to go into a deep dive. That knocks out quite an array of businesses. Then we're looking for companies that have generated a return on their invested capital of twice their cost of capital over at least a 5-year period. So that knocks out quite a few, as you'd imagine. We're looking for very modest EPS growth. So we do appreciate that companies can accelerate their EPS profile, but we started a modest EPS growth number, but it has to be positive. And then we don't like businesses that have a lot of leverage. So we knock out companies that have got over 4 turns of net debt to EBITDA. We're actually not buying businesses that levered either, but sometimes we've got a mandate to pay down debt. So we start to look at them when they are sort of starting to de-lever, if you like. And then the last element is shares on issue. So companies that are issuing equity like confetti keeps us out of that original example I provided you of the good old Australian roll-up story where you're using scrip to buy businesses, but you're essentially diluting existing shareholders, and returns usually follow over time. Or the high-flying tech businesses where it's not unusual at the moment to see technology businesses now issuing 10% of their revenue in equity compensation, which makes it very, very difficult to generate EPS over time, because you've got this huge hurdle of dilution coming through every year. So that process alone gets us down to about 200 companies globally, which that pass muster, and not all of those are interesting. So we complement that with other screens. We get on the road, we meet with suppliers, we meet with competitors and other businesses that within that chain that throws up some interesting ideas. And there's also businesses that need to make some pretty solid adjustments to their financials to get to what's special about the business. So they won't come through the screens. They're just going to come through good old-fashioned elbow grease and getting out there and meeting with companies and figuring out true economics.
So that's so talking to suppliers, that would be part of the stage 2 process, doing the initial due diligence. Is that right?
That's usually stage 3. So stage 2 is really quick. So it's really about so we're stage 2 is stage 1's filtering, stage 2 is the rapid DD, and that's about FactSet, Bloomberg data, putting templates together. It's really fast, stripping information out of annual reports and off websites. You'll have competitor information in there, but you generally haven't spoken to the competitor yet. And we don't care about typos and formatting and all that sort of stuff. Like, no one's going to care if the report, like what the appearance of the report looks like. It's all about speed. And so that gets them put in front of everyone. That's our sort of first working document of flicking through the pages. And we've already read the report before we come into a meeting. We stole it from Bezos that you give everyone 15 minutes again before you sort of enter into the conversation to look through that document again. And you're going through it, and it's not about reading it and looking at holes in someone's investment thesis. It's about reading this document and saying, how can I help? So what's the information I can bring to this conversation about whether this is, what have I seen in other industries, or are there other businesses within the chain here that can sort of lend or put some light on our original assessment of this business?
And then for the third stage, that's where you carry out much more intensive information. But just going back to stage 2, I think a lot of analysts can get caught up in spending too much time. But how much time would you spend doing that rapid
Not more than 2 days. And that's pretty strict. So if it looks like someone's put too much effort into a report, they usually get called out about it. Like it's a stage 3 report, not a stage 2 report. Sometimes people can get super enthusiastic about things and get lost a little, and that's fine. Like, we're not going to throw tantrums about it, but generally, the emphasis here is on speed, and we're not going to miss too much here that it's going to disrupt the decision between this going through or not. They're the big buckets of information that we're trying to get to, and it's very formulaic in the way that we work through that. So speed is paramount. And
it's closely linked to the key metrics that are outlined in stage 1, or?
Very closely, exactly right. So it almost kind of mirrors that process in a lot of ways, unless there's something special. I don't have the report in front of me, but essentially how it sort of comes through is brief description of the business, brief description of the industry, what that looks like, qualitative factors about management or the culture of the business, and then it sort of moves into financials about revenue, the drivers of the returns, margins, capex, working capital, balance sheet metrics, cash flow conversion, and then the body of the report goes into ESG, and then risks. We usually try to attach a short report if we can find one to the bottom of the or a summary of that short report. So we're trying to invert our thinking, and then follow-ups at the bottom, which is I put this report together in 2 days. Here's the things that I think need follow-up. Is there anything else we can add to that? But essentially just runs through that process every single time. So there's no surprises in the way that we debate those businesses. But when you've done it 1,000 times, literally, it becomes really clear about whether this is a business we want to take through to stage 3 or not.
Have any of those that didn't quite make the stage 3 process made it back into stage 3?
They sit on. We've got a sort of a bench, which is businesses that we're very happy with and we're just waiting for price. And then we've got another list, which is, companies that have come through either the screen or met with that look vaguely interesting, but there's some things that need to improve before they can get through to the stage 3. And that might be, we need management to move on, or they need to stop acquiring, or they need to come back to what's special about the company and understand where their true value is, or there's some elements of the business we need to track for longer before we get comfortable with them, especially in the retail market. There just might be, a few hairs on them that we're not quite comfortable with yet. And if we did take it through to stage 3, we probably still wouldn't be comfortable with them. So let's just park it for a while and see how things develop. And once again, pretty formulaic in the way we go back over that list on a quarterly basis to see if any of those things have changed. And then once again, debate it again. These things have changed. Do we take it through to stage 3? And if the answer is yes, then roll up your sleeves and let's get going.
Yeah. So reading your investment handbook, you highlighted the importance of finding capital light or businesses that can deploy growth capital at high incremental rates of return. Would you say that rapid review is trying to extract as much information as possible to get to that destination?
Yeah, I mean, that's part of it, for sure. I mean, that's sort of the crux of where you're trying to get to. So if you've got a business that is generating a 25% return on the capital that they deploy, they shouldn't be paying a dividend, that's for sure. They should be sort of doing that as fast as they possibly can until that opportunity set is no longer available to them. And it's really trying to assess the risks around them doing that. And so that's sort of the crux of the whole report, that we're, what's the return on invested capital? How has this been generated, and is it sustainable? There actually isn't even a valuation metric on that first report. We don't even bother with valuations. We're trying to figure out is this a Fairlight stock or not? Valuation is completely agnostic at this point, because at some point in the cycle, stocks are going to be expensive, and every once in a while you get a chance to buy back stocks which are previously way too expensive, but it might be a one-off opportunity to do so, COVID or the current growth sell-off we've got at the moment. And so it's really the returns on capital that we're trying to get to.
So the qualitative ingredients that contribute towards higher CROCI, I guess, cash returns on capital invested. So I guess the industry section of that rapid report, is that a telltale sign of whether or not there's going to be high returns on invested capital?
Yeah, I mean, there's all sorts of things that can drive that, right? So it's not unique to a particular business. There might be a network effect that drives it. It's been sort of very well articulated over the last decade or so about what's happening in the tech market there, or it might be an industry that's consolidated to the point where it's an oligopoly, and all the management teams communicate to each other through their annual reports that pricing's going up this year. It's a very rational industry. There might be a piece of IP that sits on a chemical compound in a chemistry business that sustains, and they've got strong patents around that, or there's a squillion things that can go into the formula that allows a business to generate a good return on invested capital. And what you're looking for is signs of erosion there. So it's a great business. There's pretty good evidence to suggest that businesses that generate great returns on capital tend to do so over a long period of time. And what you're really on a mission to do is figure out any reasons why that might be impaired.
So reading your recent monthly update, that was very reassuring to investors in a bleak world out there. You emphasize the importance of return on capital, and are you able to unpack the empirical evidence that supports why often businesses that are able to generate high cash returns on invested capital often provide higher earnings, and then that kind of travels in the same direction as the share price?
Yeah, I mean, there's plenty of evidence out there that supports that. I mean, McKinsey did a pretty good study on businesses that generate good returns on capital, and they do so over a long period of time. I think Munger sort of made a quick that a stock return sort of over time approximates a return on capital. I think I'm sort of paraphrasing there, but essentially I think the message is correct, that and it's mathematically true, right? If you're not generating a return on your assets above your cost of capital, you're destroying value. I mean, you're just putting a product in the market where you're not generating an economic return, that the outcome for that business is going to be pretty ordinary over time. Now, returns on invested capital, if you don't have ways to deploy that capital, isn't quite as powerful. So you might have a business that generates fantastic returns on capital, but you've got no way of growing your earnings. So you're kind of limited to the dividends that you can pay out or the shares you can buy back at a discount to sort of really drive your return. So if you have a combination of a business that generates fantastic returns on capital and great ways to deploy capital, that is nirvana. So essentially you're like, all right, we're going to put a new factory out there and it's going to cost us $100 million, but we're going to get a $25 million return on that year one. And you can do that in multiple markets, then the mathematics of that are pretty clear to everyone, right? So it's a combination between a business that generates high returns and ways to deploy that capital, which is important. And that's been proven out over a long period of time. Now, the mathematics of how that comes together is that you can, for these businesses, you can pay a much bigger multiple than you would originally think, as long as that sort of works out over the long term. So we had an example in one of our monthlies of a business called Ansys, which showed sort of the return profile of that business, but you could have paid 60 times earnings for that company over the last decade and still generated a very reasonable 10% return per annum on that business, even if you got a multiple contraction back to the 30 times in the example that we used. Now, we don't do that, by the way. We're not advocates of going out there and paying 60 times earnings for businesses. We think you need a nice margin of safety because you're going to get some wrong. And we're also big fans of getting a PE uplift on our returns rather than a contraction over time. But it's really just showing, it was just an example to show the power of EPS compounding over a long period of time, and the most correlated element to EPS growth essentially is returns on capital and their ability to deploy it.
I think it's important to emphasize that when you say EPS, earnings per share, that's cash earnings and not your traditional metric of the reported accounting metric.
Yes, which, everyone's got sort of different definitions of that. We're a little stricter than, I guess, the sell side there in terms of what we are happy to add back to get to a cash return or cash EPS number. We add back things like customer list amortization, but we don't add back things like stock-based comp, which has become pretty popular in the States, especially in tech. The idea that the money that you're paying to people for doing a job in shares rather than cash not being a cost, we can't quite wrap our head around that one. So we're a little stricter on those elements. We typically don't add back things like businesses go through restructures on an annual basis. They have that restructure charge going through every year, like clockwork. We don't add those back, for instance. So it becomes a bit of a judgment. And then on the flip side of that, there was an interesting business book written called The End of Accounting, which sort of gets into the details around how you might be understating your EPS. So it doesn't capture things like the return you get on the softer elements like R&D or patents or network effects over time, are never captured in the balance sheet, but they will be captured in years 5, 6, 7, 8, and 10 in your EPS, but they're very, very hard to measure. So there's a little bit of subjectivity that comes into forecasting, but for what we can control, we're pretty strict on what we add back.
I noticed in your in the February update, there was a very interesting graph showing all your current positions at that point in time, showing very high levels of cash return on invested capital, some with 100%, and some, most of them were over the cost of capital of 10%. Can you explain why some companies are able to reach such high returns and some just are still great businesses that are earning just above cost of capital?
Yeah, that sort of comes into the question of like, why would you bother owning the ones with a 12% return on capital when you can own one with 100% return on capital? Yeah. Well, it's not just the return on capital that's important, but it's the defensibility of that return as well, and your ability to also deploy capital. You might have a business that's generating a 100% return on capital, which would be the case for a company, say Rightmove, which is the equivalent of REA, based down here in Australia. Now, it doesn't have any capital invested. Essentially, that's a website portal, and they're generating cash from a network effect, which is listings on one side and real estate agents on the other. However, their ability to grow is somewhat marred by the fact they've maxed out their pricing. So the models here for these portals is you start with a base level of subscriptions, and then you increasingly egregiously gouge your customer base, which happen to be real estate agents over time, by upselling premium subscriptions. So you want to be on the front page, or you want to have a property that's sent out first in the email, whatever it might be, and you sort of pull that pricing lever as much as you possibly can. Now, we think that Rightmove's sort of at the end of that journey, so their ability to sort of push pricing and margin is somewhat impaired, but they're generating fantastic returns on invested capital. At the other end of the spectrum, you might have a business, I'm using an example here of a company that still generates very attractive returns, a company called Trex, which manufactures composite decking into the housing market, replacing wood. It's got the composite decking market has a 25% share in the US, and they've got within that, Trex has got a 50% share within that market. They're taking share of about 3% per year. Now, the return on invested capital there is sort of more like 20% or 25%. It's still really attractive. But what's powerful about that model is that they're able to grow their earnings by deploying more capital at that rate of return. So they open a new factory, they can service new markets, they can move internationally at that rate of return. And so you're not quite comparing apples with apples. Still got businesses with great returns on capital. One's got a greater growth profile than the other, essentially. And then at the very end of the spectrum there, we sort of refer to businesses with 10 to 12% returns on capital. That's usually companies that sit within our turnaround bucket. So they're still generating a return better than their cost of capital, but there's something that they need to do to get that business back to something that looks more like 20 to 25%.
I liked how you used the real estate.com example. Do you think it's become so big in Australia that, as you said, they're a bit limited with their pricing ability? And do you think they're in the process of potentially mortgaging their moat, where they're really just providing maybe less value to their clients and customers by lifting prices?
It does get to that point for any company, and we're really mindful. We really like companies that have inherent pricing power but don't flex it every year. So to give you an example, there's a company we own called Jack Henry in the portfolio, which provides all of the financial plumbing to the credit unions and small banks in the United States. So essentially, if you're a credit union, you need a core banking system. So rather than developing that yourself, Jack Henry will do that for you. Very high customer retention rate. So the idea of rip and replace for these systems is not one that a chief technology officer is going to suggest to the board lightly. So you've got this sort of really lovely installed base, and you go in there and you try and sell them additional services every year. Now, Jack Henry has had CPI escalators built into their contracts for every year in the past 20 years. They've never executed on that. So they've never put their prices up on their existing products. And the reason for that is they're like, we want to be invited back to sell more product to these guys. Now that's changed this year because the whole industry is putting their prices up because of wage inflation. So it's the first time ever they've had to do it, but they've got so much goodwill built into that business for not executing on that pricing, that when they need to do it, they can, and they hopefully don't get their customers' noses out of joint. Now that's a lot different from an REA and a Rightmove to an extent, where you've been pushing prices through at 10% per annum for the past decade. At some point, even if you've got the greatest moat of all time, you just don't want to piss off your customers to that extent, because what you're looking to do is inviting them to try and find an alternative. That might be difficult. You just don't want the idea of people actively looking for an alternative and pissed off with you to the point where they're very happy to support someone else. So you're right. There is a bit of a balancing act there, and we prefer the Jack Henry approach to the businesses that gouge a little bit too much.
Do you carry out any qualitative checks to monitor that value proposition between the business and the customer?
Yeah, we do. So we talk to a lot of customers, ex-employees, people in the value chain, industry experts, a lot of people that just have knowledge of how the industry works or what the culture looks like. And then, we obviously do the analysis on volume versus pricing on an annual basis as well, where we can get the data. So that sort of gives you a pretty good view as well. That's more quantitative than qualitative, but we do a combination of both. And you get a pretty clear picture of what a culture looks like after you've spoken to sort of 5 or 10 people that surround a business. Some people have got a bit of an axe to grind, so you try and sort of moderate their view, but normally you get a pretty decent sort of range of outcomes that you can normalize to this is a business that has a under promise over deliver sort of culture that doesn't gouge their customer base, that they're looking to drive their returns by adding value to their customers rather than sort of extracting financial rent. So yeah, we do all of that, and it's a huge input into the idea of trying to hold these businesses for a decade or more.
Yeah. Is it a bunch of qualitative factors that go into trying to assess whether, well, the defensibility of the moat? Because I think I find competition to be a very strong factor personally.
Yeah, I mean, once again, what we're trying to get to is whether return on invested capital is sustainable, and a big part of that is the moat of a business. And so we're very mindful of new entrants into an industry. So especially into a good example would be, once again, Jack Henry. So they work in the financial services industry. How is the banking industry changing? Are digital wallets becoming a bigger deal? Do people want a traditional bank? What does that mean for the industry? We've got neo banks coming in or digital banks coming in. People don't have street frontage anymore. So what do these sort of changes to the industry mean for Jack Henry's clients, and therefore for Jack Henry? And so we go through that process of speaking to all the competitors, all the listed new software as a service guys, to understand exactly what parts of the market they're targeting, whether they're getting traction, what they can and they can't do, whether they're partnering with Jack Henry or whether they're competing with them, whether Jack Henry's sort of acting as a bit more of a platform like an Apple where you're plugging into it through APIs, or if you're going direct to these client bases. So yeah, we do all of that, and we're trying to really get to the idea of how defensible is this moat, is it being eroded over time, and are they becoming more or less powerful in that equation?
So just reviewing a lot of these companies, they're quite technical. It's definitely outside my circle of competence. But in terms of keeping your pulse on the industry dynamics, what kind of things do you guys do to do that?
Yeah, I mean, we obviously speak to all the companies and all their competitors, and once again, we're speaking to unlisted or people that are not in the listed sphere. So professionals or consultants or industry players or employees or whoever it might be, to really try and understand those markets. We're obviously reading all the reports that you can sort of generate online to understand industries, etc. But it's really that those conversations we have around sort of how these businesses work, and getting out on the road and going to New York or the Midwest or wherever it might be to sort of understand these companies from the bottom up. Is it's unfortunately it involves a lot of elbow grease, but it's one that we're pretty dedicated to.
So just jumping to the financials. So monitoring the gross margins is important to keep a track of how strong their competitive advantage is. How do you react when suddenly, 1 year of results, it may have gone down materially, and then how do you assess that moving forward?
Yeah, I mean, margins are really important. There's quite a few inputs into that, and sometimes the margins are less important than your ability to sustain them as well. But high margins are really important in a high inflationary environment, obviously. So if you've got a 10% business that generates a 10% operating margin, and they can't push through their costs, and they got a 10% increase to their cost base, their earnings are going to be down 90%. If you've got a company with a 30% margin and they've got a 10% increase to their costs, their earnings are going to be down 23%. So it's still not great, but it's more manageable. So high margins are really, really important, but it's the sustainability of those margins as well, which is critical. So you don't want to be one of the people spend a lot of time thinking about what organic revenue growth numbers are going to look like. But if you sort of run through the maths of what happens if you ding your margins by 300 basis points, normally they swamp what's happening with the top line. So we're very, very focused on whether we think we're at peak margins and whether those margins are sustainable. So we spend a lot of time doing that. We tend to not get too freaked out about sort of quarter to quarter earnings sort of misses versus the sell side too much, because there's a lot of noise around what happens in the quarters. But we do sort of on an annual basis, which is how we model our businesses annually, sort of look at whether there's a trend there and whether we're missing something from a industry analysis point of view that should be moderating our views across the sort of portfolio, if you like. Some of the, obviously on the gross margin line are very different to what you're going to get on the EBIT line. So the gross margin line is what we're seeing at the moment, which is commodity price inflation. How much of that can you pass on to your customer base? And if you can't, then you need to cop it on the chin. And so you better be pretty efficient on what you're doing on your SG&A, your selling, general admin sort of costs to offset that. And can you do that? Well, we prefer businesses that can put their prices up to cover their gross margin line. And we're also very interested in businesses that are looking on an annual basis, whether it's a high inflationary period or not, and what they can do in SG&A. So yeah, I think it's just a case by case assessment and making sure that we're not missing anything on those two fronts.
On the top line for revenue growth rates, does your team try and forecast that, or what is the process in relation to that?
We do. So we forecast out over 5 years, and then we sort of get into a terminal value, which we're putting a terminal year that we're putting multiple on. So it's really about getting into what we think is a normalized EBIT number over that 5-year period, and we are forecasting the revenue growth over that time. Now, it's rooted in what's happened in history. So if you've got a business that's been growing at the GDP plus a little bit because they're taking some share, and then all of a sudden in the forecast you've got them growing at 15% per annum, that's going to raise some eyebrows amongst the rest of the team, and you're going to cop some questioning on sort of why those forecasts are quite that high. So we are very much rooted in what's happened in the past and why things might change. And that's a good discipline to go through, because it's one thing to say this business has historically done X, but there are good reasons why that might change. There might be a consolidation in the industry, or they've bought the number two. There might be some new management teams that are coming with more rational pricing on how they think the industry in general. There might be, some cost benefits across the business where there's less on the growth side, but might change the margin profile of the business. So there's all sorts of things that might change. So you're really looking for some inflections there as well, not only on the growth line, but the other inputs into the model over that 5-year period.
Yeah. So historically speaking, you're going back in time. It must take a lot of research and effort to really understand what was going on back in, because you do model out from 2006.
Yeah.
So are you relying on the annual reports and what management's talking about? Are those the sources of information that you rely on?
Yeah, I mean, we start there. So we read through all the annual reports and sort of go through what the management teams promised that year and whether they've delivered that by the end of the year. And then essentially, once we get through to stage 3, we're inputting all of the financial information from that annual report into the model. So there's nothing that really sharpens your mind like knowing exactly what's in the cash flow statement. And you do that by keying it in. You're like, oh, that number's a bit funny. Why did that not compare to 2015? There's something that's sort of changed there. The working capital profile of this business is kind of flipped. Well, that's interesting. So you just pick up nuances of sort of going through the detail and making sure that you're sort of stepping through every line item of it. And, it's an onerous task to go through, but at the end of the day, we're only invested in sort of 30 to 40 companies, reasonably concentrated. So I think that having the hurdles reasonably high there about what's understanding how this business has changed through a full market cycle. So the reason why I go back through 2006 through 2010 is to say, well, that was a pretty vicious cycle. How the business go through that period, and how has it changed over that time? Has it got sort of better and worse? Is it more defensible? Is it less cyclical? That sort of stuff. The only way you can really get there is if you go through every sort of line item of the business and understand them in depth. It takes a lot of time, but we're here for 8 to 10 hours a day. We've got to do something with our time. Let's read some annual reports.
And to build that picture of the environment in 2006 and onwards, do you put in comments in the modeling? So if anyone was to pick it up, then they'll be able to understand what was the circumstances that led to the company's situation now?
Yeah, we even take it a step further than that. So we work in an unusually open environment amongst our team. So it's not intentional, but I noticed over the years, especially working in bigger teams, there's a natural tendency for people to kind of selectively provide information to the team. And it's not intentional. It's just that if you've got a strong view of whether a stock is a buy or a sell or whatever, sometimes you provide supporting evidence on a selective basis to sort of support that view. Human nature is just a heuristic that we all do. So instead of doing that, we actually built custom software or developed custom software in partnership with a fintech business who we were very lucky to partner with in very early days. That software is now sold into the market more generally. But what that means is that every time that we touch the model, or every time we speak with management, or every time we write an investment thesis, it's all logged into that system and time-stamped. So it's not about getting all weird and sort of monitoring what people are up to on a minute-by-minute basis, but it's more saying, how can we make sure that we're honest with ourselves, that the information that we're put into this system doesn't change over time, so our view doesn't change. So what that means is that, yes, we've got a model that sits behind that, but every time that we change that model, it shows up in this system, or whether the EBIT sort of moved up or down or wherever it might be, and there's comments to support that. But also every time we speak with management, that's logged in, so every question we've asked them and every answer they've provided. So if I get a question from one of the guys, look, we spoke with the management team in 2020, and we've had a development in the first quarter of 2022, does that gel with the conversation you had with them? I'm like, well, I've got no idea. I could make something up, I guess. I mean, I could use my imperfect recall to try and conjure up what that information was, or I can rifle through my old notebook and try and find the notes for that. Instead of doing that, we've got it all digitized. And so the questions, we either travel with an iPad and a keyboard, and we type that information as we go, or if we're on the phone, we're typing it directly into the system. And it just means that it's all logged. We can click on it and a touch of a button, and everyone in the team's got exactly the same information on that business as the analyst. So to your point, if we need to change coverage, or we want to hand that stock over, which we sometimes do, like sometimes people put their hand up and say, look, this business could do with a fresh set of eyes. I've gone through a downgrade here, and I feel like I've got some heuristics starting to creep in in my thinking. Maybe we hand this stock on to someone else, and they look at it from a fresh set of eyes. They're not starting from a starting point. They've got an investment thesis, they've got prior notes, and they can try and come at that information with a more balanced view.
Yeah, that's a very neat piece of software there, and it's great to see you're trying to automate that process as well, trying to save that time and focus on what's more important, which is the quality of the research. Are there any ways where you can actually record audio transcripts and then you can kind of put that into the worksheets or the notes as well?
We try and automate as much as possible. I'm not too sure about the legalities of recording someone on a phone call, so we sort of try and avoid that. But it's pretty accurate in terms of, we've got a set of questions. We're all touch typists. I mean, all you're missing there, I guess, is a potential sort of Chinese whisper situation where you mishear something. But the notes are pretty comprehensive, and there's probably no need to sort of have a recording there. And we're trying to summarize it as well. Like we're all time poor. Let's try and get the points down here of the answers that were provided. And then, there's also nuances. You're typing, you get the answer, and you're putting into a bracket, not sure about that, question mark, check, or whatever it might be. You don't get that through a recording either. So I think typing is, and having those notes in a written form is pretty powerful. And I think it's probably the best way of getting the information down, to be frank.
Yeah, that's great to hear. So I'll jump on to valuation, part of your process, which you lightly touched upon. So I understand you have a specific way to value businesses, and it's based on applying a multiple on normalized earnings.
Yeah, so we've got two valuation techniques, one which we use as our sort of core, and then another which we cross-check it with. So we've got a 5-year no-plat valuation, which is sort of a shorthand DCF, if you like. And it looks out over 5 years, and at the end of that period, there's a multiple we're happy to pay for the terminal value of the business, which we flex up and down based on a bunch of quality criteria, which we score in the same way for every business that we look at. So there's a number of inputs into that, but it's sort of covers rational pricing, quality of management, cash conversion, a bunch of other metrics, which we think, to your point earlier, why do businesses stay quality and why do they continue to generate a good return on invested capital? It's kind of a shorthand of what we think is important. And so all of those scores go into what we're happy to pay for that business after year 5, after we've sort of got to that normalized earnings number. Now, we don't kid ourselves, and I actually listened to one of your prior interviews with my old friend Ben from Hayborough. He's a good man. I listen to him sort of talking about the perils of DCFs, and we completely agree with that. Like, what we're trying to get to here is an approximation of what we think this business is worth, and so we'd rather be approximately right than precisely wrong. We also compare that to what you accurately described as our normalized cash PE. So we're getting into a normalized cash EPS number today, and we're sort of comparing those two to make sure that we're sort of somewhat grounded in reality. But we're very much of the view that there's a lot of different ways to value businesses, and they're the two primary ways that we go about doing it. But we do supplement it with other techniques as well. So there might be a business which got really depressed earnings, and you can compare it across an industry, and if it looks really cheap from a price to sales point of view, there's probably good opportunity on the margin side. Or, this might be a business that, lends itself to the old price to book methodology of the old value sort of techniques of valuing the business. Or there might be a revenue sort of generation story here that's very difficult to pick up on a 5-year time frame. So there is some flex there, but generally it's those two techniques that we use to sort of frame up 90% of the way that we sort of look at a stock.
So I think, do you apply the same multiple across? Is it dependent on the geographical location of the company and what index that's tied to?
Not so much. I mean, we're invested in developed markets only, and I know what you're kind of getting at there. So if you look at the UK, for instance, I think it's traded at a 5 PE discount to the rest of the world, on the developed world, because it's such a poor index. But because we're really comparing quality businesses to quality businesses, we essentially start with the same starting multiple, and then we're flexing it up and down based on a whole bunch of criteria. So quality of management, all that sort of stuff, which gets us most of the way there. And the sort of idea that you should be paying more for one market or another. Sometimes they normalize over time as well, not always. And sometimes they're really skewed by the inputs into the so the UK, for instance, very heavily UK banks and utilities and these really capital intensive businesses. So is that a really good starting point? Not so sure. So what we used is the 15-year average of the US market, and then from there we're sort of flexing up and down. Now we're really only in developed markets. So we're UK, we're in Europe, we're in we're a bit of an overweight to Switzerland, and we're in developed Asia. So we might be wrong by a turn or two on the multiple, but really, the premium or discount there is going to be flushed out pretty quickly by the earnings per share profile of the business over that 5-year period anyway. So once again, we're trying to be approximately right rather than precisely wrong.
Yeah, I really like that approach. So we've patted down the whole theoretical process, and you've thrown in some really great examples as practical case studies. I thought it'd be great for listeners to actually run through the whole Fairlight Asset Management process and really dive into some business case studies. So have there been any businesses or investments that really hit the mark in terms of all the qualitative factors, and it was just really obvious from a valuation perspective?
Yeah, there's one business that a lot of investors haven't heard of, but it's one of the most interesting and protected moats that I've seen in my investing career. It's a company called Copart. So a bit of a description of what they do is they service the insurance market. So insurance businesses trying to get rid of cars that are involved in accidents on a daily basis, or more recently the floods that we've seen here in Lismore and Sydney. All those cars need to be disposed of in some way. And then on the other side of that transaction, Copart's selling to either parts suppliers, so guys that want to sell secondhand mufflers, or increasingly into the secondhand used car market. That's especially true when they're selling into less developed countries where their requirements for safety is not quite as high. Now, we're not talking about selling cars that are patently broken, but things like you've got a Mercedes that's involved in an accident in the US and the passenger side airbag deploys. You can't sell that car again in the US, but you can sell it into developing countries like in Eastern Europe or into Asia, where quite frankly a lot of those vehicles don't have airbags on the passenger side anyway, or it might be a sensor problem on the bumper, or there might be some element to it. So essentially Copart sits in that transaction of collating all of the insurance companies, and then there's thousands and thousands of used car dealers and parts distributors, and there's two massive barriers to entry. The first one is that it's the Amazon effect of having this flywheel of an auction, essentially an auction house of buyers and sellers on one side, and that becomes more powerful every year as you've got more product to sell. The customers sort of become more attracted to that. And then the other element is physical, where you've got thousands and thousands of beaten up vehicles where you need to store them somewhere. And so you've got essentially junkyards sitting on the periphery of major metropolitan cities. The ability for you to get a permit for that now is almost impossible. And to your point on the qualitative factors, the guy that formed this business, Willis Johnson, there's a company, there was a book put together by him called Junk to Gold, if I remember correctly, and read it some years ago. This industry started like 30, or he started to roll this industry up some 30 years ago or longer than that. But the decision he made very early on was to own his own land. Now, modern financial theory, especially as it's taught by Wall Street practitioners, is you shouldn't be buying assets where you should be leasing them. And we kind of agree with that. But coming back to the return on invested capital, is essentially he's still generating a 25% return on the invested capital despite owning all of his land. The reason that's important is that there's only two industry players in the United States. There's Copart and another company called IAA, which was spun out of CDK some years ago. Spun out of Car Auction Services some years ago. So I got that a bit confused there. But essentially, there's only two industry players now, and there's Copart and there's IAA. And IAA leases all of its land, it doesn't own it. And what's become apparent over the last few years is that as those land banks become more valuable to the underlying landlord, they're being rezoned as residential. And so IAA is finding itself getting kicked out of those very valuable sites, and they're trying to relocate, but they can't. And so Copart's being able to step into the void there and to pick up share. It also becomes really important during these big catastrophic events such as floods and hurricanes, etc., where you need to service that customer base very, very rapidly. You need additional land holdings to supply the overflow. So Copart historically, from a cultural point of view, has had that mindset of like, let's build a business over decades rather than think about next quarter's EPS numbers. The reason we were able to buy it cheaply, or the bear thesis around this business, was essentially new cars are increasingly being sold with lane diversion type technology, and eventually we're going to have self-driving cars. Now that's all well and good, but there's some 170 odd million vehicles in the US, growing by about 20 million per annum. Less than 5% of those cars have that kind of technology involved. So this is going to be a multi-decade kind of change. It's going to happen really, really gradually. So that the knee-jerk reaction to this is going to happen tomorrow, we're all screwed from an investment thesis point of view. We'd never sort of bought into that. And at the same time, the management team were buying back. I think they bought back some 15% of the issued capital of the business over 2008, 2009. So they're on your side, buying back stock when the shares are on sale. So from a holistic point of view, great returns on capital, able to deploy that capital at high rates of return, a moat which is highly defensible, and a management team that's on your side and deploying capital well. It ticked all of our boxes.
Them actually owning the permits to those yards actually reminds me of similar companies in the Australian space like Bunnings, where they're actually securing probably the best locations, and you could see Masters failing to take down Bunnings. And it's really trying to add that extra layer of barrier to entry for new entrants. So I noticed that in 2009 and 2015 were the only years where Copart actually where revenue actually went backwards, but it still remained profitable, and just shows how resilient the business is, even in the worst of times.
Yeah, I mean, it's incredibly resilient business. And the things that really drive that company, and there's an argument at the moment that the company's over-owning a little bit. We've actually been trimming the position slightly to reflect that. But the things that drive the returns for the business here are twofold. Firstly, it's the rate of accidents, so that's driven by people driving, and the second thing is the cost of the assets moving through their auctions, so the cost of a used car. So at the moment, we've got sort of perfect nirvana, which is essentially as the economies are opening up, there's more cars on the road, and I think to a degree people have forgotten how to drive, so the accident rate's up a little bit. And at the same time, we've got used car pricing, which has gone through the absolute roof. Not only here in Australia, but especially in the States, because we haven't had new car production online because of the chip shortages. Used cars, inflation's been incredible. So for a business, to my point earlier on pricing power, yes, they've got a pricing power on the fees that they generate, but more importantly, they're protected from inflation because they're clipping the ticket on the asset price that they're selling. So as used cars are becoming more expensive, their gross profit dollars are improving, and they don't need the same level of SG&A to service those gross profit dollars. The margins are expanding and they're doing incredibly well. So yes, you're right, it's been a resilient business, but at the moment they're sort of at a point where they're sort of at nirvana when it comes to earnings per share at the moment.
Yeah, I did notice that operating margins really excelled over the last decade or so. Is the biggest cost their yard operating costs?
There's a combination of things. So you've got yard operating costs, you got sort of the SG&A that goes into sort of running the auction facilities. You've got towing costs, which is a big one. So they which is less so for Copart in the last quarter, but reading through IAA's transcripts, that really dinged their margins because they couldn't find ways to offset it. To a lesser extent for Copart because they owned a portion of their own towing fleet, but that's a big cost. But these auction type businesses generate pretty rude margins. Once you get to scale and you're essentially you and maybe one other competitor, the only game in town. They're pretty capital light businesses, even though they own their own land banks. They don't need too much else in the way of capex. They get to pretty attractive margins over time, which is the case for Copart.
Do you think the disciplined cost management by it's founder-led as well? So do you think that played a big hand in managing costs?
Definitely. I mean, founders tend to keep a pretty close eye on the bottom line because then the bulk of how they get paid is through dividends, right? So usually there's a pretty close alignment there. Now, the true founder of this business has stepped back a little bit, and it's the second generation of family that's kind of running the show now. There's been a little bit of an introduction to call it professional management. So guys that have stepped into COO and CFO roles that are outside of the family sphere, and at the margin, there's a little bit of sort of stock-based comp creeping in and a few other elements that, a bit more sort of Wall Street-like, but by and large, this is one of the cleanest P&Ls we've got across the portfolio. It's just a business where they are, for their established operations are run incredibly efficiently, but that's also combined with an appetite to continue to invest in the future. So to give you an idea, they've recently expanded into Germany, and they're trying to recreate the US experience into a market which is operated traditionally very, very differently. So it's not a business that is afraid to invest. It's just that they do so with sort of a mindset of how do we generate a fantastic ROIC out of this business in years 5, 6, and 7.
So would you spend time trying to understand how, I guess, the stakeholders in Germany or the industry operates in that space? And
yes, and there's some nuances there for that industry. So it's a little bit different from the States, where if you're involved in an accident, your responsibility as the vehicle of that owner is then transferred to the insurance company, and Copart within that transaction doesn't actually take title of the vehicle. They just act as an agent sitting between the insurance company and the end buyer, and they essentially move through the auction facility without sort of taking title of that vehicle. It's a bit different in Germany. It sounds like a pretty antiquated and inefficient system insofar as the insurance company will push it on to the owner of the vehicle to actually find a way to dispose of that vehicle. And so it's up to them to step through that process and retain title of that vehicle, et cetera, et cetera. Now, Copart has taken a bit of a different view where they're essentially buying that vehicle from the owner of the damaged car, and they're taking title of it. And the first step there is to increase volumes. So the first step of trying to develop a network effect is making sure that you've got the sellers of goods on one side before you sort of attract the buyers on the other. And that's the first step. At the same time, they're making headway in actually changing the way in which the industry works. And so moving the model more to the US over time. So that's the big opportunity, and we're not kidding ourselves that that's a 12 to 18 month journey. But if they get it right, they're the only ones doing it. So you're right. We do spend a lot of time trying to understand the nuances of that German market and how probable that is.
Yeah. Okay. That's an excellent example. Very interesting company. And in terms of just flipping it, flipping the first one, were there any investments or businesses where it was high quality, met all the marks in your checklist, but was just too expensive? How did you go about grappling the valuation piece?
Yeah, so there's plenty of those, and we generally don't buy businesses that are too expensive. But there's a good example of a company that we've done all the work on, and we're just waiting for price to come back into our hitting zone. There's a company called Nemetschek based in Germany. So brief description of what the business does is essentially trying to digitize the building process. So what architects used to draw on schematics, they sort of digitize that CAD/CAM process and then hand it on to the builders. And instead of people walking around with clipboards, now everyone's got an iPad or a digitized version of how that plan's supposed to come together. And eventually it's the building's handed off onto the maintenance crew. And so Nemetschek managed that process from the start to the finish. What we really liked about the company is the cultural side. So Autodesk in the US would be a very close comparative business to Nemetschek, but a little bit different insofar as Autodesk very much pulling the pricing lever, which we spoke about earlier. We prefer companies that leave their pricing power unchecked as much as they can, and they're getting invited back to sort of sell more software. Nemetschek would definitely have that sort of mindset. And then the second thing is that Autodesk pay their staff fairly egregiously in our view in sort of stock-based compensation. So to give you an idea, about 10% of their revenues now goes to stock-based comp, and 35% of their cash flows go back to buying back stock on the market to keep their diluted share count flat. So that is a huge hurdle every year to overcome. Nemetschek doesn't pay a dime in stock-based comp, but they still get, they pay their people really well. They pay them in cash, and they still get fantastic outcomes. Now, business with those sort of attributes don't come cheap. And so we just get to know the business really well. We went to Germany, met with their M&A team, met with their management team, met with their, a couple of their customers, etc. And so during the depths of COVID, when everyone's convinced the world was ending and no one was ever going to build a building again, we had an opportunity to buy that business, which was trading on 60 times earnings for 30 times earnings. And so we went pretty hard at sort of buying that from day one. So really, we're just waiting for these opportunities where every once in a while, these really expensive businesses become cheap enough for us to buy them. And then we separate the sell decision between our three buckets. So we've got high quality growth, stable compounders, and low risk turnarounds. Professional investors as well as amateurs suffer from disposition effect, which is selling your best ideas too early and adding to your losers too readily. Where we suffer from that the most is in our high quality growth bucket. So we're just more patient in the speed in which we sell those down. Nemetschek essentially doubled in the ensuing 12 months. And so we took out a portion of the capital. We've been trimming it ever since, and we just sold our last 1% of that business in December of 2021 at 60 times earnings again. So that gives you a bit of an example of sort of our discipline around pricing and doing the work up front so that you can buy with confidence.
Having gone through so many companies like that in the high quality growth bucket, does it get easier for you to frame a hard number or ratio, price to earnings, or the shorthand that you use to understand whether it's a sell decision?
It's very clear for businesses that have earnings. So we have a strong preference for companies that actually generate a net profit after tax. I think I'm stealing a quote here from someone, but essentially it was Terry Smith, I think he said in his last letter that a lot of the time you're investing in a business plan rather than a business in the software as a service world, where there are companies where you're pricing on price to sales or EV to sales or even gross profit to growth rates or all sorts of weird and quirky ways of valuing businesses in that space. But what becomes difficult is if the stock price is down 50%, what metric are you looking for to get confident that that's the right price? And that's really the difficulty, because you're making so many assumptions in year 10 to sort of value the business that it becomes quite esoteric. So, you're saying, well, revenue number has to compound at 25% per annum. They've probably outgrown their total addressable market at that point. And then you have to subtract, what do you think looks like a reasonable R&D number? So they're spending 50% of their dollars on R&D. Does that get back to a market sort of average of 20%? Their marketing and sales, which they're plowing all of their free cash flow back into marketing and sales, does that moderate over time, or does their churn rate start to pick up? So you start getting an assumption on assumption on assumption, and it becomes really difficult to really pin down confidence over that sort of long-term outlook. Whereas if you've got a company that's generating a net profit after tax, you can have a lot more sort of accuracy in what you think that number is going to be in years three to five. And so we skew towards the more profitable end of the software market.
I noticed the growth rates for Nemetschek was actually quite erratic. So you try and apply a normalized rate of growth through understanding the historical financials.
Yeah, and they've made a few acquisitions over time as well, which has muddied the waters there from an organic versus acquired revenue number. Now, what we've been quite impressed by with that management team is that their M&A guys are very disciplined in what they're prepared to pay for businesses. So they haven't been involved in the M&A frenzy that's gone on over the last couple of years. And they've actually invested in earlier stage businesses where they think they can add some value, but they're not paying huge multiples. So they've sort of moved from buying established businesses where they used to pick them up on mid-20s kind of PE multiples. They've sort of very rapidly moved to a multiple of revenue. And they said, we can't generate a return from that. But where we think we can generate a return is in this interesting business, which a few uni students have put together, and they've got an interesting technology, no way to scale it. Let's start to invest there. So that's on the M&A side. The business is becoming more predictable from a revenue growth point of view now. So they've kind of bedded down those acquisitions and pretty formulaic in the way that they go to market, and it's about geography expansion here. So they're moving some of their European IP into the States, and some of their States IP, which they've acquired over the last few years, into Europe. So that's reasonably formulaic. And then the margin expansion that's coming through, it's actually coming through faster than we expected, to be honest. So the last result they actually put out last night, I think they had 300 basis points of EBIT margin expansion, which is pretty impressive in a market where employee costs, especially in tech markets, rapidly coming under some pressure. So it's a reasonably predictable business these days.
It's definitely two high quality companies there. So the last one, all of them can't be great, but you definitely have one bad investment that you learned a lot from.
Yeah, so we make mistakes. Everyone sort of makes errors over time. We try to keep them as try to reduce the impact of those as much as possible. So one of the sort of lifting the kimono here a little bit on sort of how we do position sizing. When we buy a new company, we typically start at 1%. And then we sort of average into it over time as we get to know it over some quarters. There's nothing that sharpens your mind like having some capital at work. Even if you followed a company for multiple quarters or even some years, as soon as you put some money to work, there's something about it that sharpens your mind. You read the transcripts with a little bit more attention. You get a bit more paranoid about what's going on in the market. So typically our mistakes have been sort of sub 2% in the portfolio, 2 and 2.5%. And we actually haven't made an error on an annualized basis for anything that's in a full position. So anything over 4%, touch wood at the moment, we're error free. But we do make errors. And one of the errors we made was a business called Nielsen. So it was in our turnaround bucket. It's a business that's been around for a long time. They measure audiences from all the way through from analog, so outboard billboards to radio to internet traffic, et cetera. Now they've got two sides of the business. They've got what's called the watch side of the business, which is the digital business measuring audiences, and then they've got the buy side of the business, which is the old can counting market share business for fast moving consumer goods. The bear case, as we understood it, was on the watch side of the business, where the narrative at the time was that Google and Facebook and social media platforms, etc., could all be trusted to deliver their data to media buyers in a trustworthy way, where the audiences were measured correctly. We were very doubtful of that, and that thesis actually proven to be correct in favour of Fairlight, where Nielsen definitely had a part to play, making sure that all the players on the field were adhering to the rules. But what we got wrong was on the buy side of the business, where essentially all the data used to be literally counted by Nielsen. Now they've got direct data feeds into Walmart and other businesses where they can measure market share data pretty well. The second derivative of that business was actually the consulting. So using that data and going into a Heinz or a Campbell Soup or wherever it might have been, and helping them with their pricing decisions. So if you put your prices up by 10% here, you expect to lose market share of Y. If you do a sort of coupon program, what does that look like? We didn't understand the extent to which those consultants were driving the returns of that business. And so when the private equity guys started coming through the fast moving consumer goods businesses, then the first guys to go were the Nielsen consultants. They were like, well, we can cut some fat here by doing this analysis work in-house. We really didn't appreciate the extent to which those consultants were, literally thousands of them in the market. So we ended up speaking to sort of second tier, third tiers of management, some guys that have left to really understand the business, and it became clear to us that the bottom was nowhere near in sight. We sold that business, I think, at a 40% loss, but there were some lessons there for us, but that was one that we clearly got wrong.
It's a very interesting case study, and it's a business that reminds me of the power of disruption, but also reflecting on the financials. You could notice that there was a sizable trend of selling expenses going up. So I think that was management trying to salvage what it had in the business and trying to pivot at that point in time. But it becomes hard when you have industry structural headwinds.
That's right. I think you're becoming more and more reliant on feet on the street to deliver a service to your business rather than the scalable digital side, which is a bit of an issue. Now, I think that part of the thesis there was their cost base was clearly bloated. And there was actually a takeover offer from Elliott Financial during the week, which was rejected. But I'd hazard a guess that that's not the end of the story there. That's clearly a business that could benefit from a new set of eyes externally, but given the structural changes there, we weren't prepared to hang around for it. But there's some fat in that business that can be, I think, somewhat whittled away over time.
Your thorough knowledge of these companies and businesses is really impressive, and I think the disclosure requirements of, I guess, global companies can be much better than the ASX listed companies. So just going through piles and piles of direct sources of information like the 10K reports. What's your stance on the disclosure requirements of different countries compared to Australia?
Yeah, we've got a pretty high hurdle there. So one of the reasons we only invest in developed markets is that essentially the disclosure requirements for emerging markets are pretty scant, and often those numbers end up in people's inboxes before they do public markets. So if you're investing in emerging markets, you can make great money there, and our advice would be to use a local manager, someone that understands the political dynamics and even the family dynamics of those markets. But I think in developed markets, the disclosure is reasonably good. Even in Australia, I don't find it to be terrible. You'd always like a little bit more information rather than less. But one of the filters that we've got, and it doesn't really matter what market it is, if you open an annual report and it's over and above what's required, if this management team is making an effort to communicate what's important about the business, it really doesn't matter where they're based or what the disclosure requirements are. Like there's there's a sense here that these guys are holding themselves accountable. They really want you to understand what's going on in the business. They're making the metrics really easy to understand. They're showing you what they're measuring. These things, it doesn't really matter if it's based in the UK or Switzerland or Australia or the US. It's really about the culture and the way that these guys are explaining their business that's important to us, rather than the level of disclosure that's required by the SEC or whoever the governing body may be.
It's a matter of quality over quantity, which is right in line with your approach at Fairlight Asset Management.
100%.
And something that's really important to a lot of investors, and it's something that you've touched upon in your previous podcasts and interviews, is the psychological mindset. And we had a chat last week. You emphasized that it's been a crucial element and aspect of your development and evolution as an investor. Could you go through the key traits that you think is probably the most important for an investor?
Yeah, I mean, you can sort of regurgitate all the textbook ones here and the list of traits that you need to learn for a CFA or a university degree, or etc. But the longer I do this, the more I realize it's really in the nuances of people's personalities and human foibles, if you like, that where the value lies. So even to the extent of, can you create an environment where people are happy to debate an idea with the spirit of getting to the right answer rather than proving yourself right, is like critically important. So, I don't think that's written in any textbook anywhere, but that's going to be, going to be 90% of the way there. If you can create an environment where people are conscious of their own bias to try and prove a point rather than get to the right answer. Now, I'm definitely not, I'm not perfect there myself. No one is, but that is one of the things that we've worked really hard on at Fairlight to develop. The second one is not having a culture of retribution on making errors. So if we've made a mistake, how do we create an environment that allows people to recognize that we've made a mistake and move on quickly? So that sort of comes into use a strong sell discipline. That's really critical as well. So people don't feel like they need to dig their heels in and have their KPIs set up on getting a stock into the portfolio and trying to hang on to it as long as possible. Like, it might even be the next week that you're like, oh, we've done all this work, we've bought the business, we own some shares here. Oh, geez, I didn't look at that sort of short report that I've just discovered, and there's a bit of a quirk in the accounting here that rather than being embarrassed about telling the team about that, we'll send it around and we'll have a chat about it at the next research meeting. If it's something that's thesis busting, we'll sell that and we'll just move on to the next idea. So it's about creating an environment where people are confident to tell you what they think, and making it as least combative as possible without starting to enter into groupthink. And so that's where the balance becomes difficult, because you want to have a affable place to work, but also one which challenges people's thinking. So I guess it's that combination between creating the environment, but also being mindful of all we've got a list of 10 or 15 heuristics that we're trying to keep front of mind, combining those elements that really come together to getting to a good decision, rather than getting stuck in the details of the sort of calculation of an outcome, if that makes sense.
Yeah, I think the comment about not trying to, implementing steps or incentive structures that doesn't encourage people to get overly excited and want to introduce a new idea. But actually, I think what you're saying is reflective of a process that encourages analysts to become better investors and make better decisions and learn from their mistakes.
Yeah, that's right. And also keeping the structure as flat as possible. So some of the terrible incentives I've seen over the years is where you start building things like custom benchmarks for people to compare their results against. And so you might have, you're responsible for the media sector. And so you have this custom benchmark, and you're expected to get stocks into the portfolio, and you need to outperform that. that benchmark. It might be the case that at the moment, media is not the greatest place to invest. And so what we're trying to encourage at Fairlight is to take a portfolio view and say, well, my stocks probably aren't looking as attractive as my teammates. Well, that actually looks like a pretty interesting idea. We're happy to put more capital behind that for now. And, the opportunity set's probably not there for my own business at the moment. Let's just take a step back and be happy to sort of cheer someone else's stocks on for a while. That's really important. So not having incentives linked to short-term performance is really important. We're all shareholders in the business, so we can think long-term, which is really handy, which is fantastic. And then just encouraging people to be generalists rather than specialists. So you learn more across industries than you do going super deep a lot of the time. There's more commonality between businesses than sort of you appreciate a lot of the time. So we make sure that people are very broad in the way that they look at businesses and the opportunity sets they look at as well, which gets you away from the kidding yourself that minutia is going to be the answer to most investment outcomes.
So it seems like it would take a lot of qualitative assessments when you provide feedback to the rest of the team. So it's a matter of taking notes and noting down key things that you've seen in their development over time. That's right. And also subjecting yourself to a 360-degree review from the guys as well, right? Like, I think there's always a temptation as, the perceived leader of a group to be pushing your views down amongst the team and telling people how they can improve. But you sort of asked me, who have been the biggest influences on my investing career. There's three that have sort of been more senior than me, if you like. But I learn as much from Albise and Will these days than I do from those guys. They've got fantastic insights into the businesses. And so to think that I can, sort of have an assessment of how they're doing professionally without subjecting myself to the same process, I think it's pretty questionable. So yes, I provide feedback to the guys on a daily basis. We don't have formal end of year reviews. I think they're quite false. I try and provide sort of daily or at least weekly kind of thoughts around how we're going, or where some heuristics are starting to creep in. But at the end of every year, I subject myself to a 360 review, and I ask the guys to be super honest about that, about how I'm going, and what I can do to help make their lives easier, and the assessment of businesses simpler, and resourcing that we require, and all that sort of stuff. So I think it's a combination of both those things, and I think those conversations are pretty healthy. Yeah, when we caught up, you mentioned how you spend a lot of time working on building mental flexibility into your process. Could you expand that for our listeners? Yeah, I mean, a lot of this stuff is self-reflection, right? Like, you're trying to pick up on your own biases and your own shortcomings and blind spots and all that sort of stuff. And sometimes that can be pointed out to you externally, which is fantastic. You can have people that are asking the right questions, etc. But a lot of the time it's self-assessment. Like, where's my ego starting to creep in here? Am I starting to favor my own ideas over someone else's? Am I starting to sort of ask a level of work from others that I'm not prepared to do myself? Am I digging in on an idea because I'm trying to be right rather than get to the right answer? Is there an element here that I could be incorrect in spaces that I haven't probed before? And that's a process of extreme self-honesty, which is not an easy thing to do. Now, I think that a lot of investors these days have recognized the importance of things like meditation in their processes, and I certainly do a lot of that, have over the last sort of decade or so, developed a pretty rigorous daily process of an hour a day of walking through that process. And that allows you to kind of reset and really look at your mental recurring mental thoughts and elements where you maybe not as balanced as you could be. And sitting down and doing that for an hour every day in a very disciplined way has definitely helped on the mental flexibility side. So to the extent that you can kind of destroy your ego on a daily basis, I think that's a pretty healthy thing as well. Is there anything outside of work other than meditation that you do to keep fresh and stay mentally stimulated? Yeah, I mean, it used to be a lot more. I've got a 1 month old at home at the moment and a 2-year-old. So a lot of my time spent making mashed potatoes, etc. But I've done a lot of surfing over the years and a lot of climbing. So I spent a good stint down in Patagonia and Chile, sort of going on a climbing
12 months of sort of working my way through those regions and surfing and climbing, which is fantastic. My early years were spent skiing. So in between the university holidays, I used to save enough money to get myself into a plane ticket over to Europe or the States and take whatever job I could get there for 3 months and sort of work in those resorts and get paid $7 an hour and have the time of your life, doing it. So they were definitely passions of mine. These days, it's more about if I can get out for a run along Manly Beach for half an hour a day, then that's enough to sort of reset the mind and make sure that you're getting the blood pumping and all that sort of stuff. But I think just keeping active and balanced and making sure you're reminding yourself that, finance is important, but it's not the all and be all in the world. And I think that sort of stops you from falling into the pitfalls of, what happens to a lot of people out in our industry, which is burnout, because you need to be doing this for 10 to 15 years consistently to generate good returns for investors. Make sure that you don't burn out halfway through that process.
I think surfing is another quick activity that you could potentially fit into your hectic schedule.
Yeah, exactly. Yeah.
So for an aspirational analyst who just reflecting on your overall time and your process, it's a very measured approach, which has been built from comprehensive experience, in-depth research. It's an evidence-based approach. What would your piece of advice be for someone who's starting out in that field?
It would just be to read widely. So university will get you, or whatever course you might do, will give you the grounding you need to understand things from a technical perspective. But the longer I do this, the more I realise that it's less important than you think. So there's probably 10% of your university work that you actually use on a recurring basis. I think all of us have had the experience of rote learning a whole bunch of stuff for an exam and then forgetting it the day afterwards. So it's really about, if you can get your hands on some of the greats investors over the years, they've all written memoirs, read them all. And then, people that have achieved fantastic things in their lives, whether it's historical figures or sports people or coaches. It's always a good one. I think get your hands on those and read those as much as possible. I think read as much as humanly can widely, and then start getting stuck into the annual reports. Unless you want to be a quant analyst, which is quite different. If you want to be a fundamental analyst, which is what we do, put as much structure as you can behind things. But there's no replacement for just reading as much as you can about businesses and understanding them from the ground up. So no replacement for the good old 10K, unfortunately.
Yeah. So were there any moments when you were speaking to your peers throughout your time and then they were saying, oh, I was doing this and it saved me a lot of time to develop my career as an analyst, and you're like, oh, I wish I'd done that?
I don't think so. I mean, there's some great fund managers and analysts out there, and they all do things a little bit differently. But I guess I was just so bloody fortunate, and I'm so grateful for the path that I've had. 3 fantastic mentors, and now a team that are incredible. That don't get me wrong, there's things we can improve and do better, and we're always on the outlook for that. But I think that the reason that we've managed to get ourselves to a highly recommended rating from Zenith and recommended from Lonsec so quickly as a business is that we looked at what the benchmark was and we just tried to beat it across every element of our business. And so there's the experiences that you get along the way that allow you to do that. And so I think that the grounding that I've had and the work that we've all done collectively as a team to get to this point, I think is a pretty strong testament to sort of, I guess the backgrounds that we've had. So I'm just trying to think if there's any sort of one individual. I guess the one thing I could have done a little earlier was to start my own business a bit earlier, but that's kind of a circumstance thing, right? You have these opportunities and at a point in time, you can't really force those things. So if I had done it 5 years earlier, I would have been happy to do that, but the opportunity wasn't there. But not really is the answer, I don't think, Raymond.
Yeah. So you've emphasized the importance of people, played a huge role in your life. That leads to my last question I asked all my guests. So out of everyone in your career and your life, who's been the most influential person on your life as a professional investor and as a person?
Separate those two, but as a professional investor, and within the professional sphere, as a person would be David Wanis for sure. So the influence we had over my investing career early on, can't be understated. You have these people that really happy to sort of fly the flag for you. And David, I'm very fortunate that he, both on a professional level and making sure that I was sort of steered in the right direction from a career perspective. I've got a huge debt of gratitude, and we speak regularly and catch up, pretty much on a weekly basis still these days. On a personal basis, I can't go past my wife, who backed me or us to start a business. So I'm very grateful to her and her skill set. So she's got a marketing background in funds management. I have worked for BT for some time. And the sort of level that she works has definitely lifted the bar for the group, for Fairlight. If you look at our website and the way that we market and put our material together, and all the information that we sort of gather and put out there, that's got her fingerprints all over it. So from a personal point of view, not only sort of going through life together, but also developing professionally, she's been a massive impact as well.
Yeah, having read the book Richer, Wiser, Happier, that documents all the great investors. You could tell that it's so important and crucial to have strong relationships and strong support. And I think your wife does definitely provide that.
Yeah, I'm incredibly grateful.
It was an absolute joy to have you on the Australian Investors podcast. I think this episode is filled with so many practical examples and key takeaways for investors. I think the name of your fund is reflective of the way you approach investing, having an independent frame of mind, and also having an optimistic view on the world and really using an evidence-based approach. So I think really appreciate you coming onto the Australian Investors podcast, and I'm sure the Australian investing community will be forever grateful for you to share all your lessons and wisdom.
Oh, that's very generous of you, and thanks very much for having me on the program. And if we can do it again in the future, I'll be delighted to.
Thanks, Nick. And for anyone to contact you or find more information about your fund, what's the best contact?
You can jump on our website. There's a hello@fairlightam.com.au moniker on there, and just jump on there, and one of the team will get back to you. Or alternatively, there's an opportunity to follow us for our monthly distribution. Jump on that, and we'll be very happy to send you our monthly commentary as well.
I'll definitely be tuning into your monthly updates, and good luck with the rest of your investing career and your personal life.
Thanks, I really appreciate that.
Thanks, Nick. Cheers.
Bye-bye.